Welcome back to Real Estate Mindset. The data is in, and it is Friday morning. Happy Friday to everyone. I hope you guys have a great weekend. We have a lot to cover today. Sorry that I'm late, you guys. I barely made this live. I feel like I'm going to mess it up. To be honest with you, do I look tired? You guys, I slept horribly. I woke up at 1 o'clock last night, and then I went to bed at 7. So I had like 3 hours of sleep. I was just kept thinking about the data. Anyways, it doesn't matter. And then like the YouTube and just my mind was all over the place. What I should have done is like slowed my thinking down, maybe started praying. But anyways, I wanted to say good morning to you guys. I really want to get us to Lennar as quickly as possible. It's going to be towards the end of this video, but I wanted to kind of demonstrate to you guys how the new home builders have actually etched out a piece of the market. In other words, you guys may remember me saying that I think it was either DR, I think it was DR Horton, could have been Lennar, I think it was DR Horton, how it appears that their sales haven't gone down. So their sales, gross income is basically the same. Their stock is almost at like a 52-week high. But their net income, right, their profit is down 36%. One of the reasons why their profit's down 36% is literally, guys, these new home builders are offering insane incentives that we can't even touch. Anyone outside of that new home circle, we can't touch the incentives. So that's where I want to get us. I want to show you like what it looks like if you buy a new home versus a resale home as far as the interest rate and as far as the payment. Very interesting, but we'll go through all that stuff today. Let me do my shout outs real quick. And then I got a quote for you guys. Again, I'm really sorry. I'm so embarrassed I started late today. I'm like, why am I so tired and exhausted? It's 9 o'clock. Geez. Good morning. Liam, I appreciate you, brother. It's always nice to hear from you. There's my man, KOV. Good morning, KOV. Good morning to you as well, sir. Todd, always like to see you. And I have been getting your emails, Todd. I got to be careful with the emails. I can't click the links. But if you guys have some stories you want me to report on, please send them to me. I actually have done a video from an article Todd sent me. Also, James. I haven't seen James in a long time. Sean and Wendy. Always nice to see you. God is amazing, Sean and Wendy. Kim, you know I'm going to say my shout outs. And I saw your comment yesterday, Kim. I saw what you said. Kim said, don't worry about the haters. Give a shout out to your core subscribers. You know, I'm going to do that, Kim. I'm sorry. I must have been a little sensitive yesterday. I was just trying to get through the video as quickly as possible to give you guys value. I'm happy it's Friday. I'm so worn out, though. I've worked so hard. Mary, good morning to you. Night Cray. Sacred. There's Melissa. That's one of the champions. She's like Lamar Odom, the fifth man. Like she can never get first. I'm kidding. You got first yesterday, Melissa. I saw you, girl. You got Dave by 1 second. I love these guys. Good morning to you. Good morning, Sheldon. From the beginning, I am blessed, and so are you, Johnny. Always. You guys, look at some of the comments from Johnny. Absolutely hilarious. Cameron, I appreciate you, Cameron. It's always nice to see you, brother. Again, from the beginning, I really appreciate all you guys. I want to kind of, I started this comment. I'm not sure if I'll be able to get back to it, but I want to kind of tell you guys and remind you guys like how to search your metro areas. So here's a comment basically asking me to do a little bit of research on Chicago. And again, remember, it's about self-empowerment. It's not about me doing the thinking for you. You guys know that I'm out. I've locked myself out of the house. I can buy right now. I've locked myself out of the housing market. I mean, we're going into that seasonality of decline, and we're going to start seeing that here. And don't forget, you guys, I'm also going to update this right here. I have my pen charge, so we're going to see if the Kingwood market is slowing down, or is it not slowing down? Is it getting worse? AJ, brother, you're smart. AJ, you're smarter than me. I read your comments sometimes, brother. You blow me away, man. Keep on preaching it, guys. We got 2 IMs, okay? We got 2 IMs. I've talked to both of them. I love you both. I am good morning. Izzy, what's up, Izzy? That's one of my favorite fighters in the UFC. Izzy, I'm just saying, you guys, Izzy is amazing. Don't move. Don't be moving to Texas. Good morning. You guys know I'm going to say good morning. I'm sorry if you're just joining me, if you're a hater or whatever. I gotta say hi to everyone. I really appreciate you guys. Again, without you, I'm just talking to myself. There's my man, TR. Oh, there's Vito Saints. New home builders are crushing it. They're crushing the workers. That's for sure. They're just right down the street. They've lost lives of the construction crew because they're such a crappy build. But he's right. They were ready this time with rate buy down strategy. Not necessarily vital. It's not necessarily that they were ready. It's just they had so much profit. Dude, the thing is they didn't have to gouge us, these new home builders. They gouged us hardcore, Vital. So it's not like they're ready. It's just they're like, all right, well, we got to waive our profits in order to sell because the market has changed. For the most part, that's my opinion, Vital. You keep me sharp, Vital, but I want to hear you being positive, man. You worry me, Vital, but I love you, or I wouldn't talk to you. You know that if I didn't love you and didn't care about you, I just ignore you, Vital. So, in other words, I appreciate you. Happy Friday, guys. Good morning, Volvo. Appreciate you all. Kraft, Berlin, that are resilient. Okay, Elena, good morning. Prices that are already downhill. Everyone's talking. Yeah, so we'll talk about the East Coast, talk about Florida. We talk about all that type of stuff, especially if we don't like it, because we need to get the big picture. And I know that if I'm not talking about it, here's why I don't shy away from like difference of opinion, because you guys are going to hear about it. I figure if we talk about it here on this channel and on the show, it's going to be better. It'll be better. And the other thing is, Atlanta, is everyone's talking about how the market's resilient and you should just buy right now. So a lot of people talk about a lot of things. It's really crazy. Good morning, Green. Happy Friday to you, sir. Dean, so much love. So many great people. Ro. Good morning, Ro. Broadwick, Elena. There's my man Broadwick from the beginning. I remember Broadwick. Paul. All right, guys, I'm going to get this started here. I'm going to get hate. DP, what's up, DP? All right. We're going to get started, okay? So let's start over here. Again, I want to get us to Lennar. This is what I really wanted to show. Well, let me show you guys Lennar real quick. I'm going to show you guys, before I get into the quote, this is where I want to get to in this video. I really want to show you guys like the reality of what's going on. Like, how are these new home builders crushing it? Why are their stocks so high? Why does it appear that they're heroes? Well, first of all, because they're offering a 4.25% fixed rate. You guys, a 4.25 fixed rate. We can't touch that. Depending on the loan amount, they're probably paying $30,000, $40,000 to get that rate. We can't touch it in resale. We can't touch that in resale. But that's where I want to get us, guys. Let's start with this morning's quote, if you guys don't mind. I really like this one. I know it's a little bit sappy, but I don't care, you guys, because there's so much hate out there. There's so much division. I'm just going to read a quote real quick for you guys. I know it's sappy. I already hear the haters. I can already hear them like, oh, you're so sappy, whatever. All right, you can't. Here it is. Here's the quote. Okay, here's the quote. Excuse me. I'm getting choked up. You can't rely on how you look to sustain you. Again, society. You can't rely on how you look to sustain you. Sorry. What sustains us, what is fundamentally beautiful, is compassion. Again, what is fundamentally, this is to our soul, what is fundamentally beautiful is compassion for yourself and for those around you. And that's so important. And notice one thing about this quote, you guys. What is before other people? Yourself, which means we got to love ourselves. And that's why I'm always trying to tell you guys, stay encouraged, because it's going to be really hard to be happy, and it's going to be really hard to love other people and to train other people if you don't love yourself, if you're not just appreciate yourself. And here's the beautiful thing. I want to tell you guys my journey, just because I know there's some people like my man Vital on the sidelines. First of all, everyone needs to chill out with rushing to buy a house. And I want to remind you guys, I struggled, okay? I had a lot of expertise. I knew how to buy houses. I knew how to flip. I made $1 million by the age of 23, okay? The thing is, guys, it took me, 11 years? It took me 11 years to buy a house again after my bankruptcy and after my foreclosure. And I want you guys to think about that. And I missed out on opportunities where I could have bought homes for 40 cents on the dollar, you guys. I went through all of that and I was forced on the sidelines. So if you think you have it bad, just remember what I went through and let that, be a little bit of light for you guys. Let it encourage you that it's okay to make slow progress on your goals, just as long as you have goals and you're not giving up on them. Society wants us to give up on our goals and go play video games and go get drunk out in clubs. I'm telling you guys. And another thing that I'm going to go through, and I'm sorry I'm preaching, it's just this quote. One other thing I'm going to go through when I get to Lennar's, I'm going to show you guys how bad consumer debt is when it compares to like what you qualify for a mortgage. So like if you have $500 worth of debt, how much does that like reduce your purchasing power? You guys are going to be blown away. So I'm going to get to that, guys, but let me start. Where do I want to start? Oh my gosh, let's start here. I don't want to start here. All right, we're going to start with our market stuff, you guys. I'm going to do the timestamp. Okay, so the first part of this video was just preaching, but I'm trying to practice what I'm preaching at least. Market update. So we're going to start with the 10-year. 10-year is just So just again, remember why I get so excited when that 10-year hits 4%. That's when things start to break, and we never stay there for very long. It's so depressing. Here's the 10-year, you guys. You're probably thinking like, I don't know if you guys have been following this. Let me actually switch back here and do it like this. I don't know if you guys have been following the 10-year or following this part of my videos. Oh, is Orlando in the house? I see. Oh, no, Todd's in Orlando. Okay, I thought Orlando was here. I was like, is Orlando here? Oh my God. The rate buy down strategy has been very successful, Vital, just not for the owners of the houses necessarily. But I do agree. Now, the 10-year, okay, you guys may be wondering what the heck happened to the 10-year because 4 days ago we were at 4%. You guys remember? I think, was it 4.09% on the 10-year? This over the last 2 days, you guys, has drastically dropped. It's dropped what? I don't know, 25 basis points roughly, maybe a little bit more than 25, around 25 to 30 basis points. That's a pretty huge drop, you guys. Now, my initial inclination when I see something like that, I'm like, dang it, we need it higher. We need it higher for longer. But if there's something breaking in the background, like we don't know, okay, then maybe it's the right thing to do. But here's the thing, credit tightening. Okay, I was going to open a report from the senior loan office. It's like a senior loan officer survey about credit tightening. Credit tightening appears to be working. One of the things that the Federal Reserve does not want to do that I've been listening to and heard, and one of the reasons for the skip is they don't want to tighten so fast and cause so much credit tightening where they destroy the economy. And remember, that was one thing that happened during the great financial crisis. It wasn't just subprime loans, you guys. They also completely crushed buying demand back in 2009 through the Dodd-Frank Wall Street Reform and Consumer Protection Act. So they basically like shut down lending and re-regulated the entire industry. Probably something similar is going to happen with realtors and realtor commissions because of that huge lawsuit. Nevertheless, the 10-year is up, 1 basis point today? It's nothing. It's absolutely nothing. But take a look at the interest rates, guys. Okay, here's what mortgage rates are sitting at right now. Probably it's going to stay around 6.9 as we go into the weekend. But again, this is good credit. We're still pretty high, considering how high prices are for houses right now, but we are sitting at 6.89. So I want you guys to remember that. That's the comparison I'm going to use to what Lennar is offering. So remember, this is a 6.87%. That's what you get if you have great credit, your 10% down payment, you don't have too much consumer debt, right? You may get a 6.87, but let me flash back here. Look at this. This isn't even credit specific. They're offering you a 4.25. You guys, that's what? That's more than 2% lower than this. That's like 2.5% lower. That is crazy, 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 crazy. Anyways, so let me get to this next article. This next article sucks, man. This next article sucks. I don't know how much you guys know. Let me pull this article up. I just did a timestamp. This makes me sad. Okay, so Bullard. Okay, Bullard was, he's basically stepping down from basically being a part of the Federal Reserve. Let me tell you why that sucks. The reason why that sucks is Bullard he was the hawk. Bullard was one of the hawks. Even though he wasn't a voting member, so he didn't have voting power, he was always basically banging on Jerome and the Federal Reserve on like, hey guys, we need to lift interest rates higher. We need interest rates higher. That's this guy. He quit. He quit yesterday. Makes me sad. Now, I don't know if he quit. I watched a Meet Kevin video on this, and Meet Kevin was like, he quit because he was wrong, and which is possible, which would be sad. But also it's possible that he quit because he's sick and tired of the circus show. I mean, think about it. I mean, how long has he been doing this? I mean, he's a grown man. He's very intelligent. I'm sure he understands the circus show. So he could have quit because of the circus show, or he could have quit because he was wrong about inflation being transitory, although I don't think so, at least in shelter. And also, you guys, one just quick reminder on the CPI report as far as shelter is the inflation on shelter is double the pace, more than double the pace. So I don't see much progress in the housing market or in shelter, but we lost a soldier yesterday. It sucks. I'm just saying, I know he wasn't a voting member, but at least he was there yelling at people. Or at least that was the impression that I had. So let me just read a couple of the bullet points. But St. Louis, no, Bullard, no. St. Louis Fed President Bullard says he's stepping down in August. And this was like abrupt and sudden. Am I wrong? Like he did this after the two reports, the CPI and the PPI report came out. He stepped down to me. Like that's suspicious to me. That was sloppy right? I mean, that's what it felt like to me. It didn't feel clean. It felt dirty. It felt like there was an issue. But anyways, the bank said he's leaving to take a position at Purdue University effective August 15th. Props, right? Props. Purdue University, pretty nice. He's going to start teaching people. Props to him, man. I love teaching, even though the money is not there. Definitely the peace of mind, the empathy. I mean, the being fulfilled is there for sure. It's also added that Bullard has. This is the crazy part. I mean, I kind of feel like something happened because it just feels dirty. But anyways, it also added that Bullard has recused himself from his monetary policy role on the Federal Reserve's Federal Open Market Committee and other related duties and has ceased all public speaking. Don't you guys think that's abrupt? Don't you guys think that that's like he's upset at something? To me, he's upset at something because he's leaving right in the middle of QE, right in the middle of being in the front end of a recession. And he's recused himself. He's not speaking to the public. I mean, I get it. I know there's policies and procedures, but this to me reeks of he does not like what's going on. I won't get into all this, guys. It is what it is, though. But I do want to show you guys this. Yeah, you guys see what I'm saying? It is abrupt, right? It is abrupt. I mean, it's just when I read that and I saw it was Bullard, I was like, no. It is what it is. It is what it is, you guys. I know we're making progress on eggs. Let me show you guys this. This is the VIX. Okay, let me refresh this. Let me explain what this is. And I've been watching this and I'm kind of I like to be a person where I'm not just talking. Okay. I know I can't be right about everything. No one can, but I like to put my money where my mouth is and I like to stay transparent. And that's one of the things that you guys get with me. I'm not going to hide anything. I'm not going to try to deceive you or make money off of you. I really enjoy being able to educate and watch people grow. I love hearing Jeff happy. I love Vital being able to, beat me up a little bit and that calms him down. These are things that I feel like we really are a family. But I mean to say, I may buy VIX. Okay. VIX is basically the volatility index. And right now, you guys, it's and this, first of all, I want to tell you, I am not giving you financial advice. Do not follow anything I am saying when it comes to stocks. Okay. Absolutely nothing. I lost $35,000 at the beginning of this year. And guys, I'm not a rich person. I'm not rich at all. $35,000 is an entire year of wages for my wife. So that was a lot of money. And I actually sold. Good thing I sold because I would have lost 40,000. Well, I would have been down 40,000. About 40,000 instead of 35. Anyways, here's the VIX. This is the volatility index. This is basically saying that everything's okay in the economy. So that's why I want to buy it because no one else is buying VIX. So usually when no one else, I got to be careful because we're talking about the stock market. I know very little about, but I may next week, you guys, just again, to put my money where my mouth is, just to show you guys, I am really believing everything I'm saying. And not only do I believe it, I'm walking it out. I think I'm going to buy some VIX. I think I'm going to buy it either Monday or Tuesday because again, you guys, I think all of the good news is here. I think it's going to get worse from here on out, to be honest with you. I think that's going to go up. It's not even, again, that's not really even showing any type of recession, any type of issue. I'm not saying that you guys should buy some, but I may put just a little bit in there, just so we can watch it together, maybe 4,000 or 5,000, right? Just so we can watch that together. We can say, all right, put our money where our mouth is. It's going to get worse from here on out. I don't know. All right, that's just what I'm thinking. I am watching VIX that is incredibly low. So now, you guys, let's do this part of our exercise. If I may, I'm going to do this. Okay. All right. So let's see what's going on in Kingwood. Now, I will say that it sucks. Okay. It sucks. We're going to see if Kingwood made any changes. How do I want to best do this? I'm going to do it like this. Okay. And I'm going to split the screen like this. Oh, you guys can't really see that. That sucks. All right. Well, I'm just gonna do this. We're just gonna make this easy. Okay. Wait a minute. Didn't I say I was gonna make this easy? Well, I'm not making it easy. I know. This is just what I'm doing. I'm just gonna fill it out as we go along. So I've already done it, you guys. Here's the active listings for Kingwood. I don't have to. Someone made a comment, and it was a good comment. I am staying in Kingwood just because that's where we've been the whole time. I don't want to really manipulate anything. Kingwood is a very small metro area. Real estate is about hyper local, going into the actual subdivision of property. So I can move on if you guys want to go to like a bigger area, like the Woodlands, for example. A lot of people know about the Woodlands, so I could do that. But just for the sake of what we're doing now, we're comparing week over week data because probably the market's going to start getting better. That's what I'm assuming. Now, the thing is, let me throw this up for us. Okay, let me go back here. So first of all, I'm going to write all this down. All right. So, and then I'll fill out the other thing. But I wanted to show you guys that there are currently 82 active listings in Kingwood. Dang it. I hate that arrow thing. I'm going to go right there. Sorry. Still getting used to all these buttons. Okay, so there are 82 active listings in Kingwood. Now, this is a bummer because there's an additional 3 listings that are coming soon. They're just not updated yet, so we should have 85. And then also what's interesting, guys, is probably 2 days ago, for some reason, we were sitting at 86. So the reason I'm saying that is because we have the same. So we started Monday with 82, and now we're starting Friday with 82. So as far as that's concerned, we have made no progress there. We did in the middle of the week. It is what it is. So I'm going to check all of this because this is how this is how realtors should be giving data. One of the ways realtors should be giving data to their clients. Okay. So I've selected all of the listings here. I'm going to go back to stats, but first let me see how many homes are listed. Okay. So here's So one other thing that we're looking at as well is how many homes are listed in $120 a square foot and under, and right now we have 7. So we have 82 total listings. We have 7 that are 120 or under $130 a square foot, with the lowest actually being $115 a square foot. So it's nice to see that 115. But let's analyze this by doing tabular stats. Okay. All right. Let's see here. So the DOM, you guys, the average DOM is 43, and the average purchase price is 542. 216. So again, what we're doing here, we're just doing a simple update. We're doing a very simple update, just comparing to where we were at before. And the market, okay, so the market's going to look a little bit worse. Let me throw this up here, okay? So the market in Kingwood's still a little hot, all right? Still a little hot. Okay, so this side here is where we started Monday, okay? Let me just turn my pen on. If my pen is dead, ooh, I'm going to be so upset. All right, so that's where we started Monday. Here's the stats for Monday. Can you guys see that? Now, today we are at 82. Okay, so that's exactly the same. However, the amount of properties in the $120 a foot square range also shrunk. That shrunk down to 7. So that shows that there are still buyers in my market, that little tiny market. Now, DOM went down slightly to 43. Okay, median average list price, that also went up. See what we're doing, you guys? We're doing real-time analysis. Now, obviously, I understand. Here's the thing. So, okay, this is the same. This went down. This went down. That went up. So essentially, we don't want to see none of that. Sorry, I flipped to the wrong camera. We don't want to see none of that. Crazy that just flipped. Again, it was at 86 like 2 days ago. I don't know what happened, but there's still buyers there. But I did want to show you that because at least you guys, it's live, accurate data. We don't have to wait for Case Shiller is the point I'm trying to make. Let's get started now. I showed you guys the VIX. We're going to listen to our first video. Our first video is very refreshing. Okay, so we're going to start with a refreshing video today. Okay, it's from the San Francisco Fed president. So her tone is a little more hawkish when it comes to like inflation. And by the way, we're not even talking about core PCI. Everyone's talking about this bum data like CPI and PPI. Like, what about the core, right? Core, that's really what's important. That has like the majority of shelter in it. But fine, have your little celebration for your little CPI, which is completely bogus, but whatever. But you guys are going to like this video, I think. Again, San Fran Federal Reserve president. Let me pull this up here for you guys. It was refreshing to hear a lot of what she was saying, to be honest with you, because again, it was like, thank God, like there's a little bit of hawkishness especially because we lost Bullard. All right, you guys, let me know that the audio is good. Definitely appreciate you guys for hanging on.
Mary Daly, also our own Steve Leisman is joining us. Good morning to both of you. President Daly, you said at the beginning of the week that you thought a couple more interest rate hikes were necessary this year. That was before we got the CPI report and the PPI report, and CPI was a lot softer than expected, now only 3% on the headline. Do you still think we need a few rate hikes this year?
So what I said is that that's a reasonable projection. And I think the most important thing about a reasonable projection is it preserves optionality. Now, there is no doubt that the good news on inflation is good news indeed, mostly for American consumers who are going to have some relief in their pocketbooks for high inflation. But I think it's too early to judge. And Steve has heard me say this more than once. It's really too early to say that we've to declare victory on inflation. This month of data is very positive. I hope it's part of a downward trend in inflation, but I am in a wait and see mode on that because I remain resolute to bring inflation down to 2%.
President Daly, could you talk about the sorts of things that some folks thought might alleviate the need for you to hike more? Things like bank credit tightening and also the lagged effects of monetary policy. One of your colleagues thinks that we've seen the effects we're going to see. Do you still see more to come from the 500 basis points that you've raised?
So the way I think about it is, and I start with the research evidence that comes out of the economics profession. And what we find again and again is that the lags in monetary policy, there is no real consensus, but there's a rough estimate. They're between 12 and 24 months. And that's a lot of time difference, but still 12 to 24 months. If you think about when policy first became restrictive, it was last year, middle of last year to September of last year. So that means there's still, in my judgment, cumulative effects of monetary policy to work their way through the system. And I think that's part of the slowing we're seeing right now in the labor market, in inflation, in consumer spending. These things are all consistent with the lag still working their way through. But I also recognize that we can't just, hold out hope that lags are going to solve all our problems, which is why we have to remain resolute to do enough, bring the rate up to a sufficiently restrictive place, and then hold that rate for the time it takes to bring inflation clearly back down to 2%.
How about bank credit tightening? Is that something you still see is going to slow the economy?
It's a great question. And right after the initial banking stresses, my own estimate was that could be being important, worth about 1 or 2 rate hikes. And at this point, when I talk to banks throughout my 12th district and look at the aggregate banking numbers throughout the United States, you really don't see that kind of credit tightening. You don't see right now credit tightening that's far in excess or even in excess of what you would expect given a slower projection for the economy and economic growth. So I take that as there isn't as much credit tightening as I thought, but I do think that from the research literature that this takes a while to show itself. And so I think we're still looking into the fall before we would have a declarative statement to make about the extent of credit tightening and the effect on the economy.
That's important.
Yeah, I mean, so far so good, as you say, on that front, President Daly. So if you look at that and you look at some of the recent data, the fact that housing looks to be picking back up again, the growth figures are pretty much intact. The consumer's not falling apart. The unemployment situation is not really a problem. It's still a tight labor market. Does it make you worry that inflation could bubble back up here and that you might need to go even farther to protect that scenario from happening?
Well, I'm certainly mindful of the fact that while we've put over 500 basis points or about 500 basis points of tightening in the system over a rapid period of time, we still have an economy that has a lot of momentum. And this is why we continue to say, well, we are going to keep working on rate hikes until we are sure that inflation is on a path to come down to 2%. It's one of the reasons, as you mentioned earlier in the program, that, I said 2 rate hikes this year is still a reasonable projection. It's for that very reason you said. It is a risk that we under tighten. It's a risk that we over tighten. And that's why data dependence, meeting by meeting decisions is so important. Right now.
And I would imagine wage growth in particular. How much do you weigh that as a factor, and what do you see happening there?
So one of the things that I think is an underknown fact is that wage growth often follows inflation. And so it's really hard to say that wage growth is going to lead inflation down. But we do know firms are paying a lot more to compensate their employees. And yet at the same time, and this is the irony of this particular expansion, is that firms tell us that they're paying more to get workers, and workers are telling us their wages can't keep up with inflation. So it is ultimately the job of the Fed to bring inflation down so that we have a normally functioning economy where workers get paid, firms feel like they can still make a profit, and workers don't feel like they're falling behind on a treadmill each day because inflation chews away their wage earnings. That's what we're trying to do.
President Daly, I want to shift gears a little bit and talk about the demise of Silicon Valley Bank, which was in your district. Viewers know it was in the San Francisco district. And we've reported here on CNBC that bank presidents are not in charge of the supervision of banks that size. But I do have a couple questions from the reporting that I've done. Were you aware of the interest rate, of the flaws in the interest rate model at Silicon Valley Bank, even though you did not have direct supervision over the bank?
So the way supervision works, and it's a really good opportunity to help your viewers understand how Fed supervision works. It is directed by the Board of Governors. The supervisory framework is in the board at the Board of Governors, and then the reserve banks. I have teams here in San Francisco, supervision teams, and they report to the Board of Governors. And this keeps me ring-fenced, rightly so, from the day-to-day operations of supervision, so that we can have Greg Becker, for instance, sit on our board and not be concerned that there's crossover. So one of the things that the viewers, I think, need to know is that bank presidents don't have a direct role to play in supervision. And in fact, that's a feature of the system that prevents conflict of interest and also allows continuity. If you're a bank in North Dakota, you're treated the same way as a bank in California. So that's the answer to the question. I'm not regularly aware of these things.
All right, y'all. So some very interesting stuff in there. We're going to look at the 5-year break even here in a minute. But some of the things I picked up on, maybe comment below. Let me know what you guys picked up on. But they're expecting this credit tightening. Excuse me. Again, I'm not bringing up the senior loan officer survey. The surveys is just so weird to me that they're so important. But the credit tightening is supposed to happen around because of the lag effect, right? It hasn't really happened right now. And I can tell you that because I'm a residential loan officer. But in Q3, so she's making it sound like Q3 around fall of this year is when we're going to start having enough data to see the type of credit tightening. Because also what she's telling us, whether it's true or not, we'll leave that up to you. But also what she's telling us is they don't want to create a devastating type of recession. And what that means is basically because they went really high really quickly on the interest rates, right? 500 basis points. That's pretty good in a year, right? That's really good. But if they do that topped with like over credit tightening, the economy is going to melt down. So what I'm hearing again is like they're really putting a lot of the eggs in the basket of credit tightening, which I've been telling you guys for the last 7 months that I think the credit tightening is super important because with credit tightening, we don't have to necessarily keep that 10-year at 4% or residential mortgage rates at 7%. Do y'all see my point? Because we have a buying problem right now. So if they change the criteria of buying as we get more inventory, I don't necessarily think that's a bad thing. Maybe you guys do. I don't necessarily think it's a bad thing. Is going up. Okay, yeah, there's a VIX comment. I mean, the VIX volatility index, oh my gosh. All right, let me show you guys the 5-year break even. Again, this is very important. Let me actually go back and do it like this because I hate that little arrow thing that happens. Okay, so this is the 5-year break even inflation gauge. This is the market anticipating where inflation is going to be in 5 years from now. This is very important to what the Fed is doing. The Fed is watching this. And I wanted to show you guys historically. So let's look at pre-pandemic, okay? So pre-pandemic, the market's expectations of inflation was generally under 2%. Do y'all see? And sometime, in 2007, it was actually 1.5, going down to 1.2 in 2016, and all the way down to 1.07 in September of 2015. So normally the market's expectation of inflation, can we say, is between 1 to 2%, okay? Very important. Now, again, we are way, we were way up here at first, but we're way up here. We're basically a tier above. So, in other words, this is saying that the Federal Reserve has more to do. Now, I also want to point out, if we really kind of like zoom in, let me see if I can zoom in more. Let me see. Okay. So, I want to point out, this is when Tuesday, July 11th is when the CPI came out. The next day, the PPI came out. So those reports beat expectations, beat them pretty good, right? They beat them. Therefore, this should have dropped, right? The market should have said, okay, inflation's starting to become under control. So this would go down, right? Y'all follow me? This would go down because the market's saying, all right, inflation's under control. It's going to be lower 5 years from now. But what's interesting is it actually went up. It went up to 2.18. And then yesterday it did go down back to 2.16. So it's really the same. The market, the 5-year break even is the same as it was before both the CPI and the PPI report. Isn't that interesting to you guys? It's the same. It actually got worse temporarily. Maybe the market doesn't trust the CPI and the PPI reports. Maybe the market is focused on like the auto market, the housing market, the commercial, residential, commercial real estate market. I don't know. Could be. Let's read our next, what am I talking about? Let's go into our next video, y'all. And again, I want to get us to the interest rates as fast as possible. I'm sorry I'm lagging. There's just a lot to cover. We're going to go now to our next video, which is going to go into the former, Federal Reserve president of Dallas. Okay, so this is another Federal Reserve president, former, and basically this is her trying to tell us what she thinks the Federal Reserve is going to do as far as interest rates, and then we'll go in after this to the CME FedWatch tool, and we'll see what the market is saying. But let's listen to what she has to say.
Here with me is Robert Kaplan, former president of the Dallas Fed and currently co-chair of the Draper Richards Kaplan Foundation. Welcome.
Thanks, Kelly.
So most significantly, let's tally up the impact. And we've all seen, I'm driving on the highway now, they're doing work and it says, funded by the I forget which of the 3 bills, there's $2 trillion in total the last couple of years. How big an impact are we talking here?
So at a 500,000 foot level, you're seeing construction spending is dramatically higher as a percent of GDP. To understand this better, you've got to go into each local market. And I do a lot of traveling around the country. What you see is many states, and the announcements are continuing, are announcing the largest infrastructure project in the history of that state. The impact of these government-enabled construction projects, when I say government-enabled because they tend to be public-private partnerships, is they not only affect construction spending, but they have a multiplier effect on the service sector. In a lot of these markets that are being done, you've got very tight labor markets already. So people are going to switch jobs to move into these new jobs. And so at a high level, it may look somewhat immaterial. At a local level, it's having a very material effect on these local labor markets and service sector markets.
Yeah, and I think in the labor market in particular right now, when we look at the claims number this morning, and things haven't really, they slowed last year. We kind of saw the implosion of a lot of the high value, tech stuff and things like that. But the resilience of the rest of the economy is the most notable thing about this year. You made an interesting point the other day that some of the localities have to spend this money before the end of 2024. And I guess the question is, do we want all this to happen? Because if you looked at it glass half full, you'd say, wow, the Fed's getting everything it wanted. Inflation's coming down and the economy's still strong. And isn't this, is Bidenomics helping, or is it, counteracting what the Fed is trying to do?
It is, in my opinion, it's blunting to some extent what the Fed is trying to do. It's not all bad because it means, I think without these projects, we might have otherwise been in a recession by now. So the economy stayed resilient. Many of these projects are good projects. These battery manufacturing projects are necessary. But many local officials are telling me, we've had this project that we've been looking at for 30 years. And because of the government money, it was marginal until we got the government money. And so all I'd recommend is I think it means if I were on the FOMC, I'd be leaning toward one more rate increase, although I'd have an open mind going in the meeting. But I would be urging, if I were at the FOMC, I'd be urging the Fed to do a lot more work in understanding not only what's been announced, but what's the forward pipeline. Because if this money were to dry up
Right.
in the out years, I think you'll see these rate increases have a lot more teeth than it looks like they have right now.
And Chair Powell, he was asked about this at the last press conference. He kind of downplayed the impact.
He did.
And we always know there's a reluctance to kind of weigh in on what the administration is doing.
And I think he said it was immaterial, although it's helping construction. And maybe at a high level it looks that way, but I think this feeds right into the wheelhouse of the Fed. You got 12 reserve banks in these local markets that I go to. It's having an impact anything other than immaterial.
Yeah.
And
Look
I'm
at
hearing
the local papers. I mean, again, I grew up outside of Syracuse. The Micron plant up there, $20 billion. It's all they talk about. We've talked about some of the Midwest locations. Look at what's happening in Arizona. This is absolutely driving the narrative in a lot of these economies.
It is. And I don't think it's going to change the action for the Fed in the next meeting, but there'll be a point at which they're going to have to decide, should we really pause for an indefinite period? And I think you've got to understand what the forward pipeline is, because I think there's a lot more coming. We're not done all Inflation Reduction Act projects, Infrastructure Act projects. Even since I talked to you just 4 or 6 weeks ago, there have been a whole series of new announcements since you and I spoke about it.
Wow.
And I just think it would behoove all of us just to get a better grip on what the forward pipeline is.
All right. So
My first one latched immediately.
I think you guys would agree with that. And we're gonna get I got to go and finish the market update real quick, guys, and then I'm gonna get into the interest rate stuff, which is really important. Boom, boom, boom. Oh, I wanted to bring this comment up real quick. So Workout basically said they don't get it. I'm gambling on the stock market, but I want to buy a home for my family. So I want to help you get it. Workout. The thing is houses cost. Well, in my price point, let's just say $400,000. If I purchased a house, I would actually be locked into the house, making a mortgage payment probably of around $3,000 to $4,000 a month. And the other thing is that you weren't understanding. I'm not in the stock market. I'm saying that if I would, and I might, $4,000 in VIX, $4,000. So I understand, but $4,000 is 1% of $400,000. Just letting you know that. And VIX is also at a 52-year week low, or almost at the low. Houses are like a forever high right now. So I just wanted to make that clear that a house is not a stock, my friend. It's not a stock. And also, if I make a bad investment in a house, I could get a foreclosure, bankruptcy, repo. How do I know that? It happened already. I'd rather lose $35,000 than 9 years of my life. You know what I'm talking about? Not 9 years of my life, but like investing life. So just wanted to acknowledge what your concern was and what you were confused about. So let's go into the CME and see if there's any changes here. This is a CME Fed Watch tool. And the market's all about expectations. It's so funny. Even though they're still fighting the Fed. Anyways, this is July. So we ended yesterday at 92.4. I think it's probably the same. Okay, 96.1. It's locked. All right, we're going to have a rate hike this month in July, 96.1. So they're saying 25 bips. Could you imagine more than that? Or what if the Fed didn't hike? The Fed's in control here, you guys. The Fed is in control, or at least they have the power to be. September, nothing. Basically not pricing in a second rate hike in September. Let's see what happened in November. November's still a little higher, I think, than yesterday, about the same as yesterday. This was up to about 40 at one point when the ADP job numbers came out. It's sitting at 26.9. So basically the market's not pricing in a second rate hike. Let's see what's December's looking like. December's at 21.6. So basically the market's not really pricing in a second rate hike. But based on what the market's saying, this is just based on the market, if we have a second rate hike, it will be coming according to the market in November. Again, that's according to the market. I'm going to hurry past there, you guys. Let's look at the 10-year. All right, let me refresh this. So we ended, I don't think this is going to be updated. Let me see. No, it's not updated yet. It updates in the evening. So here's the 10-year break even. Here's the thing that I just roll my eyes when people say, we're not, people say, Travis, you were wrong. You were horrible. You said a monster recession is what we're going to head into. And I'm just like, you guys, like, this is a cycle. Like, I wish I could just fast forward, but this isn't on my clock. You know what I'm talking about? Like, I'm not in control here. And I roll my eyes because, like, I understand, like, people want to talk some smack. Cool. I was wrong. You were right. Talk some smack, whatever. But, like, wait till, like, you don't look like a clown to do it, because we're inverted still. This is a huge, like, the biggest, well, also unemployment, right? Unemployment. But this is one of the biggest warning signs of economic pain incoming. Not here yet. Not here yet. Usually when it's here, it's above the black line. Okay. So this goes above the black line, usually when the pain is here in like full force. And then what happens after this goes above the black line? Recession. So people want to talk trash, do it. All right. As long as it's not like any type of racism or any type of like crazy psycho stuff, please share with me your opinion, but also understand that I'm really not going to pay attention to too much of it if you're talking smack until we're over that black line. Like, talk smack, if we're over that black line, we don't go into recession, everything is fine. I was totally wrong. The consumer was way stronger and way more foolish than I thought. I'm so sorry. But we are not done flying the plane. The plane hasn't even landed yet. And not only that, you guys, we are still pretty inverted. But I want to show you guys the trajectory. Let me show you guys the trajectory. There's no trajectory. Now, it has kind of appeared to re-invert, but it's just went down and then it went sideways. So it's got a lot of room to go before we re-invert. Again, you guys, going back historically, let me show you the max map. You guys can see pretty much every recession. Okay, and this is the 2-year Treasury versus the 10-year. This is not the 3-month. The 3 months even more revealing. But you guys can see, look, it goes over the black line and then recession. See, it inverts, see, and then over black line, recession. See how it inverts? Over black line, recession. Even in the little tiny recession we had in 2020, under black line, over recession. So look at the depth of the inversion now. Huge, huge depth of inversion. So we're not even, call it what you will. It is, that's a huge warning sign. This is our forefathers. Okay, this is history yelling out to the youth, our grandfathers. Please, you guys, be cautious. Economic headwinds. A child could understand the philosophy of this chart. Now, a lot of people are going to say this time is different. A lot of people are going to say that. And this time is different, but is it so different to where history changes? The entire president, the fundamentals of history change? Maybe. I don't think so. And honestly, guys, I'm not even doing anything that special. I'm just literally playing history. That's all I'm doing. Take a look at this. Okay, this is the overnight repo. This is not updated. Okay, this started going down again. It had that so this is where our money's at. I'm sorry. This is where the banks are putting their money, the deposits, which is kind of our money. So here's our money that they're making money off of. It's y'all. You know what I asked myself this morning, you guys? Why did it take till when I was in my 30s to understand this fraud? I mean, this game. I mean, the money situation, how in the tax. Oh my gosh, you guys, it's all emotion. The entire system is run off of emotions. You change my mind on that. We don't. The gold standards. Everything's emotions. I mean, look at what they're doing to make policies. Surveys, a 5-year break even. Who cares? I'm sorry. So anyways, let's zoom into this. I'm going to go into the 1 year. Okay. So remember yesterday, I was like, oh my God, the 10-year, it went down. So the reverse repo facility actually went up, which means more money went into there, but it actually went back down slightly. So I'm going to just be keeping my eye on that. More than likely, what the Federal Reserve wants to see here is they want to see the money leave the overnight reverse repo market, which is basically allowing lenders to get like 5% on their money and like keep it liquid. Like they only have to keep it in there for a day, and get 5%. Why would anyone want to go into a 2%, long-term asset, maturing asset like that if they can access their money, readily available like that? But they want this money out of here, and they want it in T-bills more than likely. So keep your eye on that, you guys. Now, what I want to do, if I may, let's go over the interest rate part. And this is going to be I hope this is going to be really eye-opening for you guys. I really want to give you guys the education in my morning lives, especially. I kind of want to stay away from the headlines, you guys, and talk about like the empowering stuff, because the reality is we can't stay on the sideline too long. Okay. I want to make that point. We cannot allow ourselves to get trapped on the sidelines. We need to be staying ahead of this recession by working on credit, income, assets, and intelligence on our market. Because imagine this, okay? When the rates go down, imagine what happens at first. So when they cut interest rates, there's going to be buyers that flood back in, and there's going to be sellers that flood back in. But there's also going to be what? More than likely, there's going to be some type of institutional investing. Okay. The reason I'm telling you guys this is because don't think that I'm trying to say the housing market's going to crash. So just stay on the sidelines forever until you see homes 50% or whatever your goal is under where they were. That's not what we want to be doing here. We want to be watching the data, not timing the market, but finding something that we love at a great deal. That's it. That's all we're really asking for. So we don't want to get stuck on the sidelines. And if we do go into a recession, understand this, it's going to hurt. Probably we're all going to feel it. Probably all of us that are watching are going to feel it. So some of the ways to stay ahead, if you guys can't stay ahead of this, it doesn't matter. What we're learning here, it doesn't matter right away. Okay. Because I want to be a winner on this thing. We got to increase our purchasing power right now. We have to keep pace with some of these other investors that are just waiting on the sideline. And again, you guys, if there's credit tightening, listen to me. Credit tightening can be a good thing so long as it's not so tight that we can no longer get a loan for a house. So again, you want to prepare for job loss. I'm not saying you're going to lose your job. I'm saying you want to prepare for job loss. This is what happens during recessions. Number two, you want to prepare for credit tightening. This whole credit tightening, maybe it's a siren. You guys know what a siren is? Mermaid sings, lures sailors to their death. Maybe the credit tightening is just a siren. Maybe it's just false, but it's important. And if we are to believe the Fed, which they don't have a lot of credibility, then that credit tightening is going to put a damper on many people's ability to purchase a home. So you can also say this, it has never been more important to get your credit up, your income up, your savings up, and your knowledge up. Don't sit on the sideline. Generally, renting is horrible, okay? I'm going to explain. Right now, I'm not saying to buy. I'm saying, okay, first of all, right now, for me and for a lot of other people, it's really, really smart to rent. But when the balance is back and it's like almost the same to own it is to rent, by owning, you guys, I get so many, I'm talking about myself. I'm not acting like a CPA, but I get so many advantages of owning real estate. You guys know that I own one house. And also I had a note for owner financing on another house, which is my primary residence. The rate of return on my primary residence is crazy. They paid off that lien yesterday. So I was at a title company yesterday, gave them a release of lien. Their interest rate was lower than what they are today. But anyways, the point I'm trying to make, you guys, is it's just there's so much advantages other than the appreciation of equity. I'm also able to, again, my own personal situation, I exceed my standard deduction when I file my 1040s or my tax return, and I'm able to deduct the interest on my house. I can't do that when I'm renting. I can claim the rent in this house, a portion of the rent in this house, for where I'm conducting a business. And that's called my home office expense. And actually what's interesting is, and again, I'm not a CPA, I'm just telling you guys my personal experience. Now, if you're self-employed, the way that income qualification works for loans is they're basically, and this is messed up, for self-employed people, they use net income. For W-2 people, they use gross. How does that make sense? It doesn't make sense. Anyways, if you're self-employed, they're going to use 2 years of your 1040s. 2 years of your Schedule Cs or an 1120, 1120S, however you're self-employed. They use 2 years of that, and they basically average the net income. Okay? So the net, not gross. But with the calculations for qualifying income, you guys hold on to this piece of information. This is important. Underwriters allow us to add back into the income, because remember, it's net income for self-employed, but I get to add back certain deductions. Okay. One of them, mileage. I can add back, I think it's like 26 cents a mile. So if someone claims 10,000 miles, I can times 10,000 by 26 cents. I got to add back that into the income. Another thing that I love to do, depreciation, you guys. Oh my God, it's so great. Oh my gosh, it's so great. So you actually get to add all of the depreciation back into your income. For example, let's say back in the year of 2019, I had a $40,000 depreciation expense on my Schedule C because I bought a truck, a company truck, and I got to add that $40,000 back into my income. Okay? Do you guys get it? Also, but I'm not saying violate the law, and I am definitely saying speak to a CPA. Something else you can add back in, home office expense. Isn't that cool? Little FYI there. Now, let's talk about loans, guys. This is going to be crazy because I'm also going to try to show you how bad consumer debt is and basically how much it really messes you up. But first, let's look at Lennar, because I'm also going to show you again. I want to talk about how these people, specifically these new home builders, are really cornering the market, and this is one of the reasons why they appear to be flourishing. Again, I want to make the point that according to their numbers, again, DR Horton, I believe, I'm like 90% sure it was DR, not Lennar, they're down 36% or 30-some% on net income because they're using that revenue, that gross revenue, to buy these rates down. You guys, 4.25%. So what I'm going to do is we're going to compare, okay? We're going to compare Lennar's 4.25% compared to what we can get on resale, and we're going to look at the difference in payment, okay? But also one other thing, I want to point out this. Look at what else Lennar's, I'm telling you guys right now, we can't touch this. Lennar is offering 4.25 fixed rate and $10,000 towards closing costs. Do y'all see that? Isn't that insane to you? $10,000 towards closing costs and a 4.25. I'm going to show you guys why they're such a powerhouse right now and why we really can't touch them. Okay. We really can't touch them. So let me just put this here real quick. So for a new house, okay, the rate is oh my God, my pen. Why does it keep turning off? 4.25. Incentives, $10,000. Okay. We're going to calculate the payment. We're just going to say the price is $400,000. Okay. So this is what we want to get. We want to see what the payment is because we want to calculate the difference of resale and new homes. And it is a big difference. Very, very big difference. I keep messing up with my cameras. Okay. Let's go back over here. So the interest rates I'm going to use is the 6 point. I'm going to show you guys what I'm going to use. It's right here. Okay. So I'm going to be using for resale, even though I know it's higher. Okay. I'm going to use the best of resale. We're going to use 6.8. Again, I know it's going to be higher. Okay. I know that for sure, but we're just going to use 6.87%. Okay. You guys follow? All right. With zero incentives and why are we using zero incentives, y'all? Do you guys know why we're using zero incentives? Because it's resale, and in resale, it's a seller's market. In new homes, it is a buyer's market. Resale sellers, new homes buyers. So we're not going to give anyone any incentives. Okay, so let me just go back to this form. So we're going to say the price is the same. We're going to say zero incentives, right, Vital? Because people are doing bidding wars right now. Is that correct? Is that correct? Okay, and then the interest rate, 6.87%. Okay, let's see what the payments are. Let's go back here. Boom. Let me go up now and do our mortgage payment. And then I'm also going to show you guys let me go like this. Again, I want you guys to stick around for the DTI so you guys see how bad consumer debt is. But let's put this in here. We're going to take $400,000. We're not even going to do taxes and insurance. We're just going to look at the payment for interest and principal. So I'm going to start with resale, which was an interest rate of 6.87. Okay. You guys see that payment right there? So that payment is, let me write that here, $2,626. Okay. Now, let's change this to, we're going to change the interest rate to 4.25, right? 4.25. Watch the payment go down. Look at that. Bonkers, you guys. Tell me that's not bonkers. Do you guys see? All right, let's go back to this. Oh my God, this is crazy. Do you guys see what I just showed you right now? Okay, the same house, you guys. Look at the payment. Look at that, $1,968. And that, my friends, is how how new home builders right now have cornered the market. Resale people cannot touch that. The difference in payment, same house, same loan amount, you guys, same loan amount. Difference in payment, you guys ready for this? Same loan amount, difference in payment, $658. Oh my gosh, per month. That's the difference. Plus what? Plus what? 10K. Pen drop. Okay, that's how these new homes. So again, let's understand like how these the reason I'm showing you guys that is that's what it takes for these guys to sell their houses. The payment is $600 to $700. Well, depending on the loan amount, $600 to $700 lower. That's how they're cornering the markets, you guys. That is a substantial reduction in interest payment. $600 a month. Oh my God, right? But let me show you guys this, okay? All right. Basically, here's what I'm going to show you guys this very, very quickly, and then we're going to be done. But basically, I want to explain to you guys how bad consumer credit card debt is. Really, any consumer debt, okay? You have to understand, in order for me to explain this, we have to understand debt to income ratio. Now, just a quick explanation of debt to income ratio. That's a qualifying factor that lenders use to determine your ability to afford a house. So there's certain thresholds of debt to income ratio you cannot exceed, which basically essentially means a certain percentage of your income can go towards paying off your mortgage, right? It's an affordability measure. Now, I'm going to talk about 50% debt to income ratio. FHA, the maximum debt to income ratio based on gross income, by the way, not net. Gross income, 56.99%. But to make this easy, I'm going to talk about the maximum debt to income ratio for conventional mortgages, so long as you have compensating factors like a higher down payment than 5%, reserves and savings and things like that. Maximum debt to income ratio for conventional mortgages is 50%. Okay, so we're going to talk about 50%. Now, how much do you guys, I want you guys to comment below and tell me how much debt in monthly payments, because DTI, the only thing that matters for DTI is the monthly payment. It's not the balance. Do you hear me? I don't care about, like, someone comes to me, oh, I have $150,000 in debt. Well, if the payment's only $100, it's not that big a deal. And then someone comes to me, oh, Travis, I only have $15,000 of debt, but the payments are $1,000. That's a really big deal. So guys, comment below. I'm going to take what you guys give me. Let me know how much you think the average person is paying in credit cards per month and in auto loans per month. And I'm going to show you how much that's going to etch out to your ability to afford a mortgage payment. It's real bad, you guys. So you guys want to give me a number? Think $500. What you think? Say the average person car loan, credit card. What do you guys want to say? Dang, 1,500, Sheldon. Not 50. I was thinking like let's be conservative. 500. Can we just say? I know it's probably more. Let's just say 500. Can we just say 500? Can we say 1,000? Oh my gosh, they're saying okay. Let's say 1,000. So we're gonna say 1,000. Dang, we got a lot. Dang, we got a lot of thousands in here. Jeez. Okay. You guys see how much faith I have in people? I only wanted to use 500 because I believe in so many people. All right, we're gonna use $1,000 now. Again. We're going to base this off of, this is crazy. $1,000, this is going to be hard for me to show you guys this, but okay. Here's what you guys need to know. If your consumer debt payments are $1,000, that means you're going to take away from affording a $2,000 mortgage payment because you have to double that. Whatever your consumer debt is, because we're talking about 50%. 50% means that our gross income goes to paying off the debt, but we have to have another 50% to go to qualifying the loan. So if I have $1,000 in consumer credit card debt, I have just removed my ability to pay $2,000 worth of mortgage. $1,000 in consumer debt takes away my ability to afford $2,000 in mortgage payment. Do you guys understand how horrible consumer debt is? Do you guys understand how? So let me put an example up here. Okay. So as an example, see this payment. Let's put the different interest rate in here. Let's say interest rate is 8%. So let's say right now I have no debt. If I have no debt right now, this is the maximum payment that I can afford. Okay. Do you guys follow me? If I have no debt right now, that is the maximum. This is hypothetical. That is the maximum payment that I can afford, a $3,000 payment. Now, if I have only $500 in debt, okay, if I have $500 in debt, that means I have to reduce what the monthly payment I qualify for by $1,000. Okay, so if I have $500 in debt and I have to reduce that by $1,000. So let's see what the loan amount would be to get to 1935. So instead of 400,000, oh, it's too much. Okay, let's go to 275. Dang, not even 275, 260? Not 265. Let's see. Y'all see. $500 in consumer debt only allows me to qualify for $265,000 versus the $400,000 that I would qualify if I wasn't in debt. Please tell me that made sense to you. In other words, what I'm trying to say is like debt to income ratio, it does not care necessarily about the size of the actual balance. Debt to income ratio is based on your monthly payments and generally what's ever reporting on your credit report. So again, $500 worth of debt can limit your purchasing power by $135,000 based on the information I just showed you. Think about it. $500 in credit card debt can remove $135,000 purchasing power off of the table for you. So that's why I'm always saying, please guys, no consumer debt. Okay, consumer debt is super duper horrible. Not horrible for the banks love it. But anyways, did that make sense to you guys? So what did we learn today? We saw how the new home builders have cornered the market. Essentially, if you buy a new home versus a resale home for $400,000, you'll be paying over $600 based on the numbers we just went over, $600 less a month, new versus resale. Oh my God. And then we also learned how bad consumer debt really is. So again, if you're on the sideline, what should we be doing on the sideline? Now, the first thing that we should be doing, the number one thing, you guys should know this by heart, the number one thing we should do if we're on the sideline is remain hopeful. Remain hopeful. If we don't remain hopeful, all of this is for no reason. Okay, so remain hopeful, work on credit, income, assets, knowledge, mindset, love your life. If you're struggling, go love some people, your spouse, your children, who know you. I was going to say your boss, just depends on what type of boss. But anyways, you guys, that is that. I barely made this live today. I'm so happy I got through it. I almost didn't make it. Happy Friday to you guys. I hope you have an absolutely blessed Friday. I am debating going to Dallas this weekend with my family. I'm debating going to Dallas. It's just, I don't know if I should go to Dallas. I want to go to Dallas. I want to cover Dallas. I just don't know if I should do that right now, you guys. I spent so much time on my video yesterday, and I only got like 6,000 views. It was one of my worst performing videos. So I don't know. Maybe you guys just like me in the studio, talk about this stuff. I don't know, but I want to go outside. Let me know if you guys will let me go outside. I want to go outside. I want to give you guys that boots on the ground. Also, again, the video I did yesterday, very interesting. This is really crazy because I found out after I had filmed, right? So after I film, I come home, go about my day, about ready to go to sleep, just hop on my phone, look at any of the news, and I come up with that article that says, the place I just toured in the area, not the exact place, in the area has the largest concentration of illegal immigration in the entire country. And it's 20 miles from my house. So I was like, oh my gosh, I don't know if you guys want me to do another video on that. I do not want to talk about immigration because I do not want to, I have unique feelings about immigration. You know, obviously the sex trafficking and the drugs and all the crime is just so bad. You guys, the entire system is just so horrible. But when I grew up in Chino, I was a minority, man. And, you know, the minority was like Hispanic and Latino people. And man, I grew to love those guys. Not getting jumped. I used to get jumped all the time by the gangs, but so it's really sucked because on one hand, like these people will just want to live their life. And like on the other hand, the system's all messed up. And on the other hand, the sex trafficking and the drugs is just like I won't go there. I'm sorry, guys. But I may do another video on that. I'll stop preaching. I hope you guys have an absolutely wonderful day. I don't know if I'm going to go to Dallas. I want to go to Dallas. I just don't know if it's worth it. You guys, this has been one heck of a week. I don't know I'm going to do lives over the weekend, but I think we made it the entire week doing a live in the morning. Thank you for joining me. I'm going to keep trying to do it. The sound of freedom. That's what I was looking for. The sound of freedom. I was a minority in Chino, California. But anyways, you guys, I appreciate you. I can't get behind. See, this is what I'm saying. I can't get, so that's why I don't want to do it. That's why I don't want to do it, because again, it's just too, I don't want to divide us. I don't want to divide us is my point. I want to keep us tight, not divided. So I probably won't be doing that video. Anyways, you guys, I really appreciate you. Handlebar mustache. I don't know. They want me to do a handlebar mustache. I don't know about that. I mean, you guys know I'd rock it if you guys really, if there's a high demand. I mean, but I would look like a complete clown with a handlebar mustache, I think. Anyways, you guys, have a great, absolutely great Friday, great evening. Don't be going to the bar, okay? Don't be getting drunk. Don't be going out spending your money. Go through the weekend, get some sleep, rest your soul, rest your heart, and then go on a walk. Something. I don't know. Either way, I appreciate you guys. Absolutely love you. If you're out there investing in real estate, you know I wish you luck, and I hope you